Hi, this is Zak Mir from Master Investor, the investor conference on April the 25th, featuring Jim Mellon, Nigel Farage, and myself on the charting front. Today's bulletin board heroes for Monday, the 23rd of February, start with JKX and oil and gas, where you can see there's been a rebound off this grey 20-day moving average at 23.4 pence. Quite a sharp rebound there, back above initial February support at 28.5 pence, and that would suggest that we're looking for decent snapback again to the upside. 35, 45 pence on tap initially, 38 pence at 200-day moving average target over the next maybe couple of weeks. In fact, this to the top of this channel could actually be heading towards 50 pence if we get decent momentum over the next few sessions. And this reversal, this U-shaped reversal, turns out to be a cup and handle formation, which at the moment it is giving every indication of being. Next up is Quindell, which is obviously a very controversial stock on a fundamental and a technical point of view. What we can see here is a rising trend channel that can be drawn from November last year, and this is obviously just a technical view, not a fundamental view here. Looking encouraging in terms of the rebound scenario, given the gap fill rebound that we saw. The gap at the beginning of January was at 55 pence. We bounced off that with the February low here and then back above the 50-day average. If you're cautious on the shares, maybe you'd wait for an end of day close above this grey 20-day moving average at 77 pence. But it does look as though we've got enough momentum here now after this gap fill to take the shares back up for a retest of the January resistance through £1.20. This stage, really, the first alarm bells would be an end of day close back below the 50-day moving average of 69 pence. And perhaps the best stop loss on the whole recovery argument here at the moment, back below 55 pence, which was, as I said, this January gap. Another controversial stock, Tern, but here we have again the technical view, not the fundamental view. The situation here is that we basically had a decent push to the upside after the break through the 200-day moving average in September, accelerating advances here, culminating in the December peak towards 14 pence. That could really be regarded as a sort of overshoot in terms of the buy scenario, and we've come back to the 50-day moving average, which is rising here at 6.25 pence on the floor of this September channel as well. So in fact, this looks like a bullish situation overall. Got the shares well above the 200-day moving average at 3.4 pence as well, and I would really suggest that we're looking for a retest of 14 pence, the 14 pence zone resistance over the next couple of months. If you're cautious on the stock, maybe you'd wait for a momentum buy signal, such as an end of day close above the initial 7.2 pence February resistance. But as I said, from most of the indicators here, it looks as though the shares are actually in recovery mode and will retest the best levels of last year relatively quickly. Finishing off with a new stock to the bulletin board heroes section, and that comes in the form of Wolfe Minerals. 2015 was always supposed to be the big year for the shares on the fundamental point of view. From a technical point of view, it looks like there's been a decent change as well, in the sense that we've got a vertical spike through the 200-day moving average at 15 pence. That's still falling, and you tend to see the best recoveries or rebounds when a stock or market breaks above a falling 200-day line, as it indicates that the momentum here is that much stronger than normal. In terms of what the upside could be above the 200-day moving average, we're probably looking for a March resistance line projection target as high as 24 pence over the next couple of months. That would also fill the gap down from early last year at that 24 pence level as well, so it ties up reasonably well on a charting view. That's it from me. More updates at masterinvestor.co.uk.